Your electricity bill arrived this month, and somewhere on it, probably buried near the bottom, probably in a font designed not to be read, is a line item you've been paying for years without knowing what it funds. In most countries, that line covers infrastructure that was built for a version of the future that never arrived. Cables laid for a demand that plateaued, capacity that the original investors assumed would keep compounding. The technology worked. The adoption was real. The problem was the shape of the growth, and almost nobody knew how to read that shape until it was too late. That shape has a name, and once you see it, you start seeing it everywhere. 4 times in modern economic history, not sometimes, not occasionally, but in a pattern tight enough to call a rule, a legitimate technology triggered a wave of investment so intense that the investment itself became the event. Not the technology, the investment. The technology was fine. It was the assumption about growth that destroyed people. And each time, the people closest to the technology, the ones who understood it best, believed in it most, were the ones who lost the most. Here is what Canal Mania of the 1790s actually looked like. And here is what it tells you about every infrastructure play being sold to you right now. Britain in the 1780s had a real problem. Moving goods overland was slow, expensive, and unreliable. Roads were poor. Horses were a bottleneck. And then canals arrived, and they genuinely solved the problem. The Bridgewater Canal, nigh opened in 1761, cut the cost of transporting coal into Manchester by roughly half. Not 5%. Not a marginal improvement. Half. The technology worked. So when Parliament began authorizing new canal companies through the 1780s and into the 1790s, the investment case was not irrational. It was grounded. The early canals were paying dividends. The demand was real. And sophisticated investors, merchants, industrialists, landowners, poured in. Between 1793 and 1796, Parliament authorized over 80 new canal schemes. Shares in canal companies were changing hands at multiples that assumed decades of compounding traffic growth. People were not buying canals. And they were buying the future that canals made possible, and pricing that future as if it would grow at the same rate forever. It would not. The first group of canals, the ones solving actual acute transport bottlenecks, paid their investors well. The second group paid modestly. The third group, the ones authorized at the peak of the mania, were built into a market that the first group had already served. By the time construction finished, the traffic wasn't there. The geography wasn't there. And the capital that had been raised on projections drawn from the early canal's success had no way of generating those returns in routes that were, at best, marginal. Some investors lost everything. Others lost decades. And here is the detail most financial histories skip past. The canals themselves kept working. The goods kept moving. The technology was not wrong. The S-curve was. The S-curve is what growth actually looks like when a real technology meets a real market. Slow at first, then explosive, the phase everyone sees and extrapolates, then flat. Because eventually, the problem the technology solved is solved. Saturation is not failure, it is completion. But investors pricing the explosive phase as if it will last indefinitely are not investing in the technology. They are investing in a number that cannot be real. Keep watching what happens to the shape of adoption, not the quality of the technology, not the size of the market. The shape. Because what Canal Mania revealed, and what the next case confirms in a way that should make you deeply uncomfortable, is that the shape of growth is the one variable almost nobody prices correctly. Does the 1890s bicycle craze looked nothing like Canal Mania on the surface. Different century, different technology, different class of investor. But the underlying structure was identical, and that structural identity is the thing worth holding on to. The safety bicycle, the design with 2 equal wheels we still use today, arrived in the late 1880s and genuinely transformed personal mobility. For working-class and middle-class people who couldn't afford horses, it was revolutionary. Real demand, real adoption. Millions of people who had never moved faster than walking pace could now cover 5, 10, 20 miles. The early manufacturers were printing money. Between 1894 and 1897, the number of bicycle companies in Britain alone went from dozens to hundreds. To share prices in established manufacturers climbed 300, 400%. New companies floated with no production history, no orders, and sometimes no factories. Just a prospectus describing how many bicycles the world would need over the next 20 years. The projections were not ridiculous. They were based on real adoption curves. The error was assuming those curves would continue at the same slope. By 1897, the saturation point arrived faster than almost anyone predicted. The working population that could afford a bicycle had largely bought one. The replacement cycle was slow. Bicycles lasted years. New entrants to the market couldn't match the prices of scaled manufacturers. Within 2 years of the peak, as more than half the bicycle companies floated during the boom had collapsed or were trading at fractions of their issue price. The investors who had held shares in the original profitable manufacturers and sold at the right moment came out well. The investors who had chased the expansion, who had bought into companies number 400 and 500 of a market that needed perhaps 50, lost almost everything. The bicycles kept selling. The industry survived. The shape of the growth curve had completed its arc, and the companies that had raised capital on the assumption it would keep climbing had nowhere left to go. What every one of these cases shares, at its core, is this. The surface problem was identifying the right technology. The deeper problem was identifying where on the S-curve the investment arrived. The people who lost were not wrong about the technology. They were wrong about the moment. This is the part where it gets uncomfortable, because the modern mirror is not subtle. Fiber optic broadband, data center infrastructure, electric vehicle charging networks. Each of these has a genuine technology case. Each is solving a real problem. Each has early adopter returns that look extraordinary and are being used to project forward demand curves that assume the explosive phase of the S-curve continues indefinitely. The same line items appearing in modern infrastructure investment prospectuses: total addressable market, compounding adoption rates, decade-long demand runways, are structurally identical to the language used to float canal companies in 1795 and bicycle manufacturers in 1896. The technology is different. The prose is the same. If this pattern matters to you, if seeing where you are on the curve before the curve finishes is worth understanding in more depth, like and subscribe. The next piece goes into the early 20th century, and specifically into what happened to investors in the electrification boom when a real, world-changing technology met the same S-curve problem at a scale several orders of magnitude larger. Not all technology booms end the same way. Canal Mania wiped out the marginal investors and left the core infrastructure intact. The bicycle boom collapsed hundreds of manufacturers and left a functional, scaled industry. Some collapses took years to recover from. Some were uncomfortable for investors who had over-concentrated, but survivable for those diversified across sectors. As the severity varies, the shape of the curve does not. The people who rebuilt from both of these moments shared something specific. They had not abandoned the technology. They had abandoned the assumption that early growth rates would compound indefinitely. After the canal crash, the investors who recovered fastest were the ones who identified which canals were still generating traffic, not which canal companies had the highest projected growth, and bought at the distressed valuations the mania's collapse had produced. After the bicycle crash, the investors who recovered were the ones who identified the 3 or 4 manufacturers that had genuine scale, genuine margins, and no dependence on a growth story they could no longer tell. They were buying the technology at the price of the disappointment, not the price of the hype. I return now to that electricity bill, that buried line item. In the UK, consumers are still paying a levy related to fibre and grid infrastructure built on demand projections that assumed the explosive phase of adoption would continue longer than it did. The infrastructure works. The growth curve completed. The investors who financed the expansion at peak pricing have already absorbed their losses. The people paying the legacy costs are the consumers who had nothing to do with the original investment thesis. This is what the S-curve looks like from the outside when you don't know you're inside it. You don't see the hype. You don't see the prospectuses. You just see the line on your bill that funds the ghost of someone else's growth assumption. The question, and it is a practical one, worth sitting with, is this. Of the infrastructure or technology investments currently being presented to you as long-duration growth opportunities, how many are you evaluating by the quality of the technology, and how many are you evaluating by where they sit on the adoption curve? Those are different questions. The first one is easy to answer. The second one requires knowing the shape, not just the direction. Canal Mania ended. The bicycle craze ended. The technology survived. The growth assumptions didn't. And the people who understood the difference between the two, before the curve completed, not after, were the ones who came out with something left to rebuild from. Comment the sector below where you think the S-curve has already peaked, but nobody's officially called it yet.